You open the news and your head spins. Jobs are strong, great, but inflation is still sticky, okay? Interest rates are high, but economic growth is slowing down. It's a total traffic jam of conflicting signals. And your first thought is probably, if the economy is this chaotic, the markets have to be panicking, right? But they're not. And this strange gap, this silence between the noisy headlines and the calm market is where most of us get lost. We assume the news dictates what stocks do, but in reality, markets are quietly running calculations that we never see. Here's the fundamental disconnect. All that economic data, it's a rearview mirror. A strong jobs report tells you what happened last month. High inflation tells you what happened over the past year. A slowing GDP report tells you the last quarter wasn't great. It's all history. The market, on the other hand, is a windshield. It isn't looking back. It's looking 6, maybe 12 months into the future, and it's only asking one question. What does all of this noise mean for corporate profits and interest rates down the road? And that is why headlines can scream chaos while the market seems completely unfazed. So how does it process all this so differently? The market has a probabilistic mindset. It doesn't need certainty, it just needs odds. Think of it like your car's GPS. If you hit an unexpected traffic jam, your GPS doesn't have a meltdown. It calmly assesses the new information, calculates the probability of different routes being faster, and just reroutes you. The market does the exact same thing. That strong jobs report comes in. The probability of a soft landing just went up a few points. Inflation is a little sticky. The probability of the Fed cutting rates soon just went down a bit. The price you see on your screen isn't a reaction to one single headline. It's the constantly updated weighted average of every single possible future. So what signals does the market actually listen to? 3 main things. First, earnings expectations. This is the bloodline. The market is constantly adjusting its forecast for how much profit companies will make in the future. Second, interest rate expectations. It's not about today's rate, it's about the market's best guess for the Federal Reserve's path forward. And third, the trade-off between growth and risk. Picture a car's dashboard. The speedometer is growth, the oil temperature is inflation, and the gas gauge is risk sentiment. One little flashing light won't cause a panic, but if multiple lights start blinking red all at once, that's when the driver, the market, reacts. It's the interaction of the signals that matters. The reason this all feels so strange, so counterintuitive, is purely psychological. As people, we crave simple, clean stories. Jobs up, stocks good. Inflation up, stocks bad. But reality is never that neat. We get paralyzed by all the conflicting narratives, and we tend to fixate on the latest, loudest headline. Markets don't have these biases. They're dispassionate calculating machines. So here's the key takeaway. Mixed signals aren't a sign of danger. They're the normal state of the economy. A calm market isn't in denial. It has already done the math. It's a sign of a system that is quietly digesting the noise and pricing in the future. The goal isn't to predict the next headline, but to understand that the market is always, always looking ahead.